Imagine waking up to find that a significant chunk of your hard-earned savings is now owed to HMRC because you missed a simple tax deadline. That's the reality facing thousands of Britons right now as HMRC introduces sweeping changes to how savings income is reported and taxed. If you have over £3,500 in savings, the next 3 minutes could save you hundreds, if not thousands of pounds. Are you one of the millions who could be affected? With interest rates at their highest in years, people who've never worried about savings tax before are suddenly finding themselves liable for unexpected payments. Could you be one of them? Before we dive into these critical changes, make sure you hit that subscribe button and turn on notifications so you never miss crucial financial updates that could affect your wallet. Also, drop a comment below with your biggest tax concern, and I'll try to address it in my next video. If this information helps you save money, giving this video a thumbs up helps others find it too. Tax rules are changing, and this time, it's your savings in the spotlight. HMRC has recently announced significant modifications to how they are handling interest on savings accounts, ISAs, and investment returns. The days of assuming your bank has sorted all your tax matters are over. These changes come at a particularly critical time as the cost of living continues to rise and every pound in your savings account matters more than ever. The government is tightening up on tax collection across all areas, and your savings haven't escaped this scrutiny. What used to be a relatively hands-off area for many taxpayers has now become a focus point for HMRC's compliance teams. Let me break this down for you in simple terms. If you've got over £3,500 in savings accounts, you could be earning interest that puts you over the personal savings allowance threshold. But did you know that this threshold has been quietly adjusted in the latest tax reforms? Have you checked if you're still compliant? For basic rate taxpayers, you can earn up to £1,000 in interest before paying tax. Higher rate taxpayers get just £500, and additional ratepayers get nothing at all. With current interest rates, a sum of just £20,000 in a savings account offering 5% interest would generate £1,000 in annual interest, potentially using up a basic rate taxpayer's entire allowance in one account. Let's put this into perspective with some numbers. Just 5 years ago, when interest rates were around 1%, you would have needed £100,000 in savings to generate £1,000 in interest. Today, with rates at 5% in many competitive accounts, you only need £20,000. This dramatic shift means many more savers are crossing into taxable territory without realizing it. When was the last time you calculated your potential interest earnings across all your accounts? The most concerning part is that HMRC is now actively cross-referencing data from banks and building societies with individual tax returns. This means they are catching discrepancies that might have slipped through in previous years. Are you confident that all your savings income has been properly declared? HMRC has invested heavily in their Connect system, a sophisticated data gathering tool that pulls information from multiple sources to create a comprehensive picture of your financial situation. They are now able to see interest payments from virtually all UK financial institutions and compare this against what you've reported. The days of interest flying under the radar are long gone. What many don't realize is that HMRC can look back up to 20 years if they suspect deliberate tax avoidance. Even innocent mistakes can be investigated going back for years. This means that undeclared savings interest from previous tax years could still come back to haunt you, potentially with added penalties and interest on top of the tax owed. What many people don't realize is that the responsibility for reporting savings interest has shifted more toward the individual taxpayer. Your bank might not be communicating everything directly to HMRC anymore. Have you checked your tax code recently to ensure it reflects your current financial situation? Previously, banks and building societies would deduct tax at source from interest payments, making the process relatively invisible to savers. Now, interest is paid gross, without tax deducted, and it's up to you to declare it if you exceed your personal savings allowance. This fundamental shift has caught many people off guard, especially those who've never needed to complete a self-assessment tax return before. Your tax code may have been adjusted by HMRC to collect tax on your savings interest through your salary or pension, but this isn't always accurate. They typically use estimated figures based on previous year's interest, which could be significantly different in today's higher interest rate environment. When did you last check that your tax code correctly reflects your current savings situation? Another crucial change affects how tax is calculated on premium bonds and certain types of investment returns. The thresholds for reporting have decreased, meaning more people need to complete self-assessment forms than ever before. Did you win any premium bond prizes last year? Have you reported them correctly? While premium bond prizes remain tax-free, HMRC is paying closer attention to how these are reported, particularly for higher value prizes. The same goes for dividend income from shares, where the tax-free dividend allowance has been steadily reducing over recent years, now sitting at just £500 per tax year. Investment platforms and fund managers are now required to report more detailed information about your holdings and returns directly to HMRC. This includes capital gains on investments sold, dividends received, and interest earned on cash balances within investment accounts. Are you keeping track of all these different types of investment income? ISAs remain tax-free, but HMRC has tightened rules around what counts as an ISA transfer versus a withdrawal and new subscription. Making a mistake here could inadvertently cause you to exceed your annual ISA allowance and trigger tax liabilities. When was the last time you reviewed your ISA contributions? The flexible ISA rules that allow you to withdraw and replace money within the same tax year without affecting your allowance are not universal. They depend on whether your specific ISA provider offers this flexibility. Assuming all ISAs work the same way could lead to expensive mistakes. Have you checked whether your ISA offers flexibility? For those with both cash ISAs and stocks and shares ISAs, the rules about transferring between the two have become more stringent. Improper transfers might result in using up more of your annual allowance than necessary or even invalidating the tax-protected status of some of your savings. When did you last review how your ISAs are structured? The new rules also affect how joint accounts are taxed. Previously, interest was assumed to be split 50-50 between account holders, but now HMRC is looking more closely at the actual legal ownership of the funds. Have you and your partner discussed how joint savings are declared? This change is particularly significant for couples where one person is a higher or additional rate taxpayer and the other is a basic rate taxpayer or non-taxpayer. The old system of automatic 50-50 splitting might have been advantageous, but HMRC now expects the split to reflect the true contribution to the account. This could mean that if one partner contributes 80% of the funds in a joint account, they should be declaring 80% of the interest for tax purposes. Have you documented the actual ownership split of your joint accounts? Could you prove this split if HMRC were to investigate? Digital platforms like savings apps and financial technology services are now required to report more detailed information to HMRC. Those micro-savings and roundup features might seem insignificant, but collectively they could push you over tax thresholds. Are your digital banking activities being properly tracked for tax purposes? Apps that automatically move small amounts into savings, round up purchases to the nearest pound, or offer cash rewards for spending can all generate taxable interest or income. Many users of these apps don't realize that these small amounts can add up to significant sums over a year. What's more, some digital banking platforms operate differently from traditional banks when it comes to how they handle and report interest. Some may pay rewards rather than interest, which could have different tax implications. Do you understand how each of your digital financial services reports to HMRC? If you hold savings accounts overseas, the reporting requirements have become significantly more stringent. International tax treaties mean that foreign banks now routinely share information with HMRC about UK residents' accounts. Have you declared all interest from overseas accounts? The Common Reporting Standard, CRS, allows for automatic exchange of financial information between countries, making it virtually impossible to hide foreign savings from HMRC. The penalties for failing to declare foreign income, including savings interest, can be severe, up to 200% of the tax due in some cases. Even if your foreign account pays minimal interest, it still needs to be declared if it takes your total savings income over your personal savings allowance. When was the last time you included your foreign accounts in your tax calculations? So what can you do to protect your savings and ensure you're tax compliant? First, review all your savings accounts and calculate your total interest income for the tax year. Many online banking platforms now offer this as a feature, or you can request a certificate of interest from your providers. Create a comprehensive list of every account that generates interest, including current accounts with interest-paying features, regular savings accounts, fixed-rate bonds, and cash held in investment platforms. Remember to include accounts you may not use regularly or that pay interest annually rather than monthly. For each account, note the current interest rate and calculate the projected annual interest. This will give you a clearer picture of whether you're likely to exceed your personal savings allowance in the current tax year. Have you done this calculation recently? Consider maximizing your ISA allowance before putting money in taxable accounts. Remember, the current ISA allowance is £20,000 per tax year, and all interest earned within an ISA remains completely tax-free. If you're approaching or exceeding your personal savings allowance, prioritize moving funds into ISAs where possible. Remember that both spouses or civil partners have their own ISA allowance, meaning a couple can shelter up to £40,000 per year from tax in ISAs. Beyond ISAs, consider whether premium bonds might be suitable for some of your savings. While they don't pay regular interest, the prizes are tax-free, and they offer 100% capital security backed by the Treasury. Have you considered whether your savings strategy is tax-efficient? If you're a couple, think strategically about whose name savings accounts are in. If one person has unused personal savings allowance and the other doesn't, it makes sense to hold more savings in the name of the person with available allowance. For example, if one partner is a basic rate taxpayer with a £1,000 allowance and the other is a higher rate taxpayer with a £500 allowance, holding more savings in the basic rate taxpayer's name could save you up to £200 in tax each year at current rates. Remember, though, that HMRC expects the beneficial ownership of accounts to be genuine. You can't simply put all savings in one person's name if they don't actually own the money. Have you had a frank discussion about how to optimize your joint savings from a tax perspective? Keep meticulous records of all account openings, transfers, and interest payments. If HMRC does raise questions, having clear documentation will make the process much smoother. This is particularly important for joint accounts where you're not splitting interest 50-50, for ISA transfers, and for accounts with variable rates that change throughout the year. Good records should include statements, interest rate notifications, and any correspondence with your account providers. Consider setting up a simple spreadsheet or using a personal finance app to track your savings and interest throughout the year. This will not only help with tax compliance but also give you a clearer picture of your overall financial position. How organized are your financial records? Consider scheduling a review with a tax professional if your savings situation is complex or if you're close to threshold boundaries. The cost of advice could be significantly less than potential penalties for incorrect tax declarations. This is particularly important if you have multiple income sources, own property that generates income, have investments outside of ISAs, or have savings overseas. A tax advisor can help ensure you're not only compliant but also making the most tax-efficient decisions. Remember that tax advice is an investment, not just an expense. A good tax professional might identify savings opportunities that far outweigh their fee. When did you last consult a professional about your tax situation? Tax rules are constantly evolving, and what's true today might change in the next budget. Make a habit of staying informed about changes that could affect your savings tax position. Subscribe to HMRC email updates, follow reputable financial news sources, and consider setting a calendar reminder to review your tax position quarterly rather than just at year-end. Being proactive rather than reactive could save you significant stress and potentially money too. Remember that tax planning is an ongoing process, not a one-time event. The financial decisions you make throughout the year can have significant tax implications. Are you building awareness of tax considerations into your regular financial planning? Don't let HMRC's changes catch you off guard. Take action today by reviewing your savings accounts and understanding your tax obligations. If this video has helped you, please give it a thumbs up and share it with friends and family who might be affected by these changes. For more detailed guidance tailored to your situation, I've created a free downloadable checklist. Just click the link in the description. This comprehensive guide walks you through every step you need to take to ensure you're tax compliant and making the most of your savings. Join me next week when I'll be discussing the little-known tax reliefs that HMRC doesn't advertise but could save you thousands. Hit subscribe now so you don't miss it. And remember, while tax rules are complicated, staying informed is your best defense. The effort you put into understanding and organizing your tax affairs today could save you significant money and stress in the future. Your financial well-being is worth the investment of time, so take action today.